Alright, so for this one, we are going to talk about corrective waves themselves. So without wasting more time, let's begin. Okay, so the corrective patterns. In Elliott Wave theory, corrective waves are subdivided into several types. Starting off, zigzags. These are sharp moves and appear as a 5-3-5 sequence. This means that the A wave consists of 5 subwaves. The B wave consists of 3 subwaves, and the C wave consists of 5 subwaves. Pretty easy, right? Not that bad. So let me show you some examples that I have here. So here are some key characteristics of zigzag patterns. This is the main one. This is just extra info for all you nerds. Wave A, this is a sharp decline or rise. As you can see, for wave A, in this case, it would be a sharp decline. Bam, going down. Wave B, this is a corrective wave that retraces some of the losses or gains from wave A. The retracement level is minimum 1% of the A wave and rarely exceeds the 38.2 level. In other words, that's just the Fibonacci level that you draw from the beginning to the end of wave A. And as you can see, it retraces somewhere around that area. I'm assuming the 38.2 Fibonacci level. Wave C, this is a final decline or rise that usually exceeds the low or the high of wave A. So as you can see, it exceeds the low point of wave A because the corrective wave is in a downtrend. Now you don't need to use your Fibonacci tool for this part. You don't. I don't use them. I just mark them up because I know that at the end of the day, it's probably touching some kind of Fibonacci point. So it doesn't really matter to me. Zigzags are typically found in the second wave of a 5-wave impulse and have a part in the formation of Elliott wave triangles. They are often corrective, hence the term Elliott wave zigzag correction is used to describe this setup. Now again, for all you dudes that are trying to do too much, you guys can read all that. I'm not going to read all that. So as you can see, the first impulsive leg, which would be impulsive leg A, you have 1, 2, 3, 4, 5. And here from A to B, which would be the B leg, you have A, B, C, 3. Remember the 3 count, the 5, 3, 5 count. And then from B to C, which would be the C leg, you have 1, 2, 3, 4, 5. As you can see, it's going down and it ends on the higher time frame in corrective wave 2. Notice how they connect once they finish. So A, B, C. C's finished forming and it finishes forming on the second wave or second corrective pattern and then goes back up. Same thing here, ends at wave 3, and then you also start from wave 3 marking up your ABCs. So A, B, C. And again, on the first wave or subwave from wave A, you have 1, 2, 3, 4, 5. And then on wave B, this highlighted, yellow highlighted part, you have A, B, C. And then from here, on this highlighted part, which would be wave C, you have 1, 2, 3, 4, 5. And then as you can see, we have the same thing happening here on a overall bearish 1, 2, 3, 4, 5 pattern. Same thing. All right. It is not rocket science. It just repeats itself. Let's move on. Now let's talk about some flats here. These patterns typically form during periods of price consolidation and appear as a 3-3-5 sequence. The A wave consists of 3 subwaves, the B wave consists of 3 subwaves, and the C wave consists of 5 subwaves. They are further subdivided into 3 types. In other words, there's 3 types of flats. You have irregular, expanded, and running flats. So irregular flats. Think of this like a regular wave at the beach. It goes up, down a bit, and then up again. All these waves are about the same size. So in other words, wave A goes up, wave B goes down, wave C goes up. Expanded flats. This is like a wave that gets bigger as it goes. It starts small, wave A, gets bigger, that would be wave B, and then even bigger, wave C. So it just keeps going, growing and growing. Running flats. This is like a wave that doesn't finish. It starts at wave A, goes up a lot, that would be wave B, and it doesn't come back down all the way to wave C. Now I'm going to show you what I mean, okay? Okay, so flats, again, regular, expanding, and running. Often formed during periods of consolidation. This is when the market is taking a breather after a significant upward or downward trend before continuing in the original direction. By identifying these patterns, traders can anticipate potential reversal points and plan their trades accordingly. Always use multiple time frames to confirm any of these. Sometimes it's really hard to confirm them if you don't use a different time frame to mark out your 1, 2, 3, 4, 5 higher time frame patterns. Traders can use these patterns to identify potential entry and exit points. For instance, the end of a flat correction, the end of wave C, remember A, B, C, could be a good entry point if the trader expects the price to resume the larger trend. So if you entered at around C, you could catch impulsive leg 3. So here, as you can see, you have your regular flat, such as A, B, C, regular flat. And then I decided to put all 3 of these in one, so that doesn't mean you'll always have, flats appearing in the same overall higher time frame wave. It can happen, but I'm just putting all of these in here as an example. On this one, you have an expanding flat. So you have A, B will take out some liquidity, right? Some liquidity grabs here. And then what will it do? Go back down past wave A. As you can see, it went past wave A, finishing the formation of corrective wave 4. And then from there, going back up. Now this is where we start mixing that SMC, ICT, all that good stuff with Elliott Wave. Now we have running flats. So as you can see, we start marking it up from the end of wave 1. So we go down, right? And then up. We have that break of structure past wave A. And then we go back down. We don't go past wave A. As you can see, it did not go past it, but it still took liquidity on top, and then comes back down. And then for all of you guys that had that limit order down here, you probably didn't get tapped into it. So another thing is, you are not going to always be able to identify or predict these patterns very easily. It takes a lot of time, and even then, it's not that easy. So it is always good to refer to these charts or to my examples here in case you might have seen or recognized a little something here, okay? And here you can see the same thing happens on a bearish market, right? So here you have A, B, C, the regular, and then we go on this one. You have A, B takes it out, C takes it out, right? And then it goes back down. And you have A, B, break up structure here, C, somewhere retraces into A, and then down. Now, I know that a lot of people are wondering, well, I thought certain waves can't go past each other. That's usually true only for impulsive waves. For corrective waves, it can be a little different. And again, even in impulsive waves, that changes, especially when you're doing corrective patterns. So that's why I said not everything is set in stone, and it can be a little subjective. But as long as you recognize what you're looking at, it doesn't matter. Okay, just make sure you mark up your stuff correctly. All right, let's move on. Now we have triangles. These are sideways moves that appear as a 3 3 3 3 3 sequence, which are all literally corrective waves. They only have 3 subwaves. These are the 3 types. You have your contracting triangles, barrier triangles, and expanding triangles. The range of price action narrows as the pattern develops. So price literally starts narrowing. Physically, you'll see it. The start of the triangle, the A wave, is wider, and the end of the triangle, the E wave, is narrower. Barrier triangles, similar to contracting triangles, but the line connecting the ends of waves B and D remain flat. You'll see what I mean. Expanding triangles, the range of price action widens as a pattern develops. The start of the triangle, the A wave, is narrower, and the end of the triangle, the E wave, is wider. So I got some examples for you as well. And again, I grouped them all in different corrective waves here, because I didn't want to make more examples, just wanted to fit them all in one. So anyways, you have your contracting triangle, A, B, C, D, and E. You have your barrier triangle, some call it ascending, whatever, A, B, C, D, and E. As you can see, you have equal highs, B and D. And here you have your expanding, A, B, C, D, and E. They're expanding as price forms. And obviously you're contracting, it's literally price contracting, like contracting, getting narrower. Now again, some people call this ascending, some people call this descending triangles. It's up to you guys. I don't care. It doesn't change the fact that I'm going to buy or sell. Same thing here. You have contracting triangles. You have A, B, C, D, and E goes down. And again, A, B, C, D, and E. B and D are equal lows. And then finally you have E goes up. Sometimes it'll swipe a little bit of liquidity with a wick and then go back down. And then again, expanding triangles starting from the end of wave 1, A, B, C, D, and E. And then finishing at wave 2, or at the end of corrective wave 2, you go down. So here I just wanted to include a little bit of a graph here. Maybe it'll help you guys out a little more. So again, you have A, B, and C. That will be your corrective wave. So you have 1, 2, 3, 4, and then 5, and then correcting down, right? Or some people can see it as 1, 2, 3, 4, 5. Okay, but point is, inside you have your A, B, and C corrective waves, and then you have A, B, and C, right? A, B, and C, A, B, and C, A, B, and C. This is all of this is literally inside of these waves right here. So inside of this, you have only A, B, and C. Inside of the B leg, A, B, and C. Inside of the C leg, A, B, and C. Inside of the D leg, A, B, and C. And inside of the E leg, A, B, and C. These exact patterns, they're all 3 patterns inside of all of them here. These have 3 patterns. This has 3 patterns. 3, 3, 3. All of them, bearish or bullish, it doesn't matter. They all have 3 patterns. So again, you have A, B, C, D, E. But inside of them, what do you have? A, B, C, A, B, C, A, B, C, A, B, C, A, B, C. I know it can be a little confusing, but let me put it to you this way. Let's say the pink right here is the 4-hour time frame. Let's say the corrective wave, this what you're looking at, A, B, C, D, E, is the 15-minute. Drop down to the lower time frame. That's where you'll find A, B, and C. That would be like a 1 minute, right? That's where you'll start finding those small little subdivided waves, A, B, C, A, B, C, A, B, C. Those would all be 1 minute. So again, this pink one would be the 4-hour. This grayish one could be the 15-minute, and then inside each of these legs could be the 1 minute. All right, hopefully that clears that out. Finally, double threes and triple threes. These are combinations of the above patterns and appear when simple zigzags or flats do not achieve the purpose of the correction. Now don't worry about learning this unless you want to. I didn't even bother looking into it as much. I did a little bit of research on it, but I was like, you know what? At this point, I'm more worried about trading patterns than I am trading patterns with price action and Elliott Wave. So don't complicate this for you guys. Like, you don't really need to learn this unless you absolutely want to be like A+ professional on Elliott Wave. I just take the overall schematic of what Elliott Wave is, and then I combine it with a little bit of price action, maybe a little bit of ICT, a little bit of this and that, and I make my own thing. All right, but don't worry about learning this part right here unless you want to. It's up to you. So that finishes this part of the episode for the corrective patterns. Hopefully you guys learned something. God bless you all, and I will see you guys in the next one. Peace.